Welcome to the Slop Temple. We pray this video helps.
In this video, I will explain how to buy covered calls in Fidelity. A covered call is an option strategy where you sell call options against shares of stock you already own. This means you need to own at least 100 shares for each option contract you sell. The primary goal is to generate income from the premium you receive when selling the call. It's a popular strategy for investors looking to earn extra yield on their existing stock holdings. Before you can place a covered call trade, you'll need an active Fidelity brokerage account. Crucially, this account must have options trading enabled, and specifically, at a level that allows you to sell covered calls. Fidelity typically has different options trading levels, so confirm yours is appropriate. Also, make sure your account is funded with enough capital to purchase the 100 shares of the underlying stock you intend to cover. Once your account is ready, log into Fidelity and navigate to the options trading section for the stock you own. You'll then select the option chain and choose to sell to open a call option. Carefully select your desired strike price and expiration date. Remember, the strike price is where you agree to sell your shares if the option is exercised. Finally, specify the number of contracts you want to sell, remembering each contract covers 100 shares. When trading covered calls, it's vital to understand the risks involved. Your upside profit is limited to the strike price plus the premium received, and there's always the risk of your shares being assigned if the stock price rises above the strike. Regularly monitor your positions and be prepared to manage them as market conditions change. For more helpful tips and great deals, including those fantastic leak-proof meal prep containers, check out the links in the description below. Happy trading!
Thanks for watching. Consider subscribing if we helped you.